to this rally, for example, that we've seen in stocks?
I don't think it matters to this particular rally. I think the Federal Reserve is far more important to this. The thing that I try and do, and it's my job to try and help ease investors' concerns around the country, at least keep them sticking to a plan. And every 4 years, election concerns come up. And some of the things, Matt, that I've been trying to tell them is, look, people were very worried when Trump won in 2016. The market was up 60% under Trump. People were very worried when Biden won in 2020, probably the opposite people. And the market's up 71% under Biden. It was up 200% under Reagan, 200% under Obama. So it doesn't matter in the broad, in the aggregate as much as people think. Since 1957, there's only been 2 times where a presidential administration ended with negative returns in the market, and that was Richard Nixon, whose term didn't finish, and George W. Bush, whose term ended in a great recession. So I do think it's overplayed from the perspective of investors watching us today. Don't allow this to freak you out of your positioning. The markets have done well historically under all parties, most presidents.
But you can trade around it. Certainly in the options market, you can trade around elections, right? Amy, you can trade around new debt numbers and deficits that are just seemingly out of control, even though strategists will say it doesn't really matter right now. I talked to Ed Hyman, and he says, if the 10-year doesn't care and if the dollar doesn't care, I don't really care that much. But what does the options market say?
Look, all it comes down to me is tenor. So it's really quite simple. I actually agree with Brian on a longer term basis. That is true. But the actual nuance, I think, to the volatility markets is if there isn't clarity about who the winner is. And I think that is a tail concern that seemed very, very low probability, but now is a little bit more high probability now. And the issue is when it's not clear who the presumptive candidates are, then you do get volatility. You get for instance, a year 2000 where it wasn't clear, your VIX spiked dramatically. And again, it comes down to tenor. Do I agree that on a 1 to 5 year basis, this is something we can look through? Sure. A lot of the investors we speak to, they're more 1 week to 3 months. And that tenor difference, I think, is where you start to trade around that. And we do see folks doing that because it is less clear now than it was before who the presumptive candidates are.
And I agree with that. What's interesting, though, and it's hard to figure, when you look at any time that volatility has spiked during election periods, it's been associated with a recession, whether it is 2000 or whether it is 2008. If you look at most other election periods, volatility has not increased. If they're not associated with recessions, then they don't increase. But I do agree policy uncertainty creates volatility. That's where it always comes from. And I'm more concerned about policy uncertainty with the Federal Reserve at this moment. I mean, to me, we probably know who the candidates are. I think that's our base case. And if we don't, I can't imagine significant changes from a policy platform perspective.
I mean, both of you, I think long-term would agree that it's about the earnings. It's about the economy, right? And that's why the Fed is important. If you take a look at the Atlanta Fed GDP now picture, it doesn't look very bright, right? They predict a continued drop in GDP growth, even though we've had this earnings expansion. Mm-hmm. It's been driven mostly by the Magnificent Seven, right? Yeah. The 493 haven't caught up yet.
Right.
Do you expect that to change?
Well, we would need a catalyst for that to change. And so, the catalyst would need to come from a shift in the policy environment. We need to normalize the yield curve and work to reinvigorate economic activity now that we're clearly slowing. And so, if you look at signs, are we heading into a recession? Do we have corporate bond spreads blowing out? Do we have bankers tightening lending standards? No. But tactically, it's an economy that's slowing. And the longer we sit here with tight policy and an inverted yield curve, the higher probability we get of a policy mistake. I'm not there yet, but I would like to see the Fed move. They just don't answer my phone calls.
Well, maybe they'll listen to this program. Amy, what do you think of the market? It's so sanguine, right? As you mentioned a few times, the VIX is so low. We can climb on the S&P with no breath at all. I've seen a couple of days this year already with 112, 113 winners, and yet we're up. Only 10 companies make up 35% of the total index and 23% of earnings. Does this lack of breadth look worrisome?
It is actually very worrisome to our investor base, and it sort of just comes down to the math. So I'll give a simple example. The days where you see small cap do well or you see breadth widen, the overall market is actually down because it's actually more of a function of the weight of the heavy mega caps. And so what we're actually seeing investors be selective about is saying, okay, I'm going to hedge, but I'm just going to use the Mag 7 as my hedge because essentially it's a proxy to the overall market anyway. And we're at a period where implied and realized correlation has just never been this sustainably low. And what happens when correlation picks up? Volatility rises, the market goes down. And to me, it's if tech goes, the market goes. We watch sentiment on those 7 names unbelievably closely, and those have not been that great. People want to hedge those names. People are more looking for protection on those names than they were, say, 3 months ago.
When is it time to rotate out of when do you take profits from the money you've made on NVIDIA and say, I'm putting it all on the Russell 2000?
And the interesting thing is right now we're slowing, and slowing means you tend to want to be in the more mega cap, high quality.
It's kind of defensive.
Names. Yeah, it's sort of like a heads we win, tails we win right now with the mega. So I hate to keep putting it on the Fed or the shift in the environment, but you would need the catalyst for that. Usually, I mean, we saw it, Matt, right, in November and December of last year. The market priced in 6 rate cuts, and yet a bull market in small caps in a couple of days, not a couple of days, but you know what I mean. And so you see what that can look like. And we've spent this year pricing out the rate cuts. So we've gone back to the mega high quality because the market thought Fed was too tight and we're going to slow down here, which of course is happening. So, you'll need the catalyst, the next shift in policy, hopefully without a recession. But even if it is a recession, the recovery out of that will be more cyclical, more small, more value oriented. So, hopefully we recover from a slowdown. If not a recession, either one of those will likely broaden out the markets.
All right. Thanks to both of you for joining us. Amy Wu Silverman of RBC Capital Markets, Brian Levitt of Invesco. We're going to take a look right now at some of the individual stocks moving ahead of the opening bell. Just 15 minutes to go. For that, we go over to Abigail Doolittle. Abby, what do you have?
Lots of interesting stories and moves for stocks this morning, Matt. Let's start off with the shares of Tesla because they're at more than 4% on that delivery for the second quarter number coming in better than expected. Close to 440,000 EVs were delivered relative to the estimate of closer to 439,000. The sentiment has been so low for Tesla. The shares really outperforming over the last 2 days, up about 10% if this gain holds. Technically, the chart is now set. That chart setting up for a big breakdown to the downside, potentially to go sub 100 if below about 118. And that simply represents buyers who bought well or below 100 on a split adjusted basis, wanting to take profits over time so as to not adjust their profit base. GameStop down 1.4%. That lawsuit we were talking about yesterday, there was an investor who sued Keith Gill for the fraud, the Roaring Kitty fraud suit, basically saying that he committed securities fraud of some sort in terms of his quote unquote pump and dump GameStop scheme. That has now been dropped. It's really interesting, Matt, because the spirit of the law maybe was stretched there, but it was clear that no law was broken by posting memes on social media. It almost seems as though there was some sort of desire to create a bad sense around Keith Gill. And then finally, Paramount up 3.5%. Barry Diller perhaps entering into the race to explore a bid for Paramount. Yet another story there. This keeps on giving.
All right, so the allegation of frauds rescinded there. Very interesting stuff. Abigail Doolittle with a little technical analysis as well. We got to get those charts, Abby. Coming up, Tesla deliveries beat expectations. We'll take a look at the EV giant next. It's selling all threes and Ys. No X's and S's. This is Bloomberg.